Hi guys, it's Stock Curry, and as the stock market is on the brink of a bullish breakout, we've got to talk about the criminals that are stealing money from your stocks. Every single major retailer is warned about this. I'm going to tell you what's going on, so let's get into it. Let's get things started with the bullish news that is causing a bullish breakout rally in the stock market. Well, as you know, the debt ceiling deadline is June 1st, which is about 2 weeks away. Now, leading up to this, Democrats and Republicans have to raise the debt limit, and they've been very far apart in their negotiations, and this was causing a lot of fear about a possible U.S. default. But then on Wednesday, McCarthy, who's the Republican leader, flipped, and that caused the stock market to start to rally. On Wednesday, McCarthy said the U.S. won't default as debt talks inched forward. Then on Thursday, he came out with an even more bullish statement saying that the House could vote on a debt ceiling deal as soon as next week. This is making it more and more likely that Congress will agree upon a debt limit deal before the debt limit deadline of June 1st that's coming up in 2 weeks. And this has caused gold prices to go down. Gold prices were originally rising over fears that the U.S. might default. Now that those fears are starting to subside, gold prices are going down. And at the exact same time, stock prices are going up. So this is really good news for the stock market. But we also, whenever we're doing any sort of analysis, even though, yes, the stock market is absolutely becoming risk on and prices are rising and all of that is great, I always want to give you the opposite just so you can kind of see both sides of the coin and understand what could propel the stock market upward and at the same time, what might propel the stock market downward. And the things that could push the stock market upward, obviously, a debt limit deal is the biggest one in the short term. Other things is the fact that the labor market remains extremely strong with unemployment continuing to drop. And that is extremely bullish because it shows a good sign that the U.S. might actually avoid a recession, even if consumer spending habits are changing. On the bear side, we do have the fact that the inflation remains well above the Fed's 2% target, which means the Fed is going to have to continue to aggressively raise interest rates in order to get inflation down. And we're going to talk more about that in a minute because the markets are currently pricing in a Fed pause as well as 2 rate cuts by the end of the year. But will the Fed actually pause in June? And it's actually becoming less likely they will. I'll explain more in a minute. The other bear case is the possible of more bank defaults as the commercial loan crisis takes effect throughout the rest of this year. Of course, ultimately, stocks are going to trade upon earnings. And how are earnings doing? Well, Home Depot had horrible earnings. It was actually their worst revenue miss in 20 years. And the stock suffered tremendously because of that. But Walmart and Target also reported over the past few days, so let's take a look at their earnings. Walmart's earnings beat expectations, and they raised their full-year guidance. Now, my big concern with Walmart is that as consumers spent less and less money on goods, that Walmart would have a suffering in their sales. And I was also concerned about their inventory glut. And when they reported earnings, it turned out that was absolutely the case. Consumers are spending a lot less money on goods. So if that's the case, how did Walmart beat earnings? Well, as it turns out, their first quarter sales rose nearly 8% as its large grocery business offset weaker sales in clothes and electronics. Nearly 60% of Walmart's annual U.S. sales come from groceries. And in the first quarter, sales of general merchandise in the U.S. declined mid-single digits, but that was offset by sales of food and consumables, which increased by low double digits. And this helps to explain why Walmart's earnings beat expectations, but Home Depot's earnings were a big miss. It's because Home Depot is largely focused on discretionary spending, things that consumers don't necessarily have to spend money on in a life and death situation. And as a result, because consumers are really financially strapped right now because of high inflation, consumers are spending a ton of money on necessities such as food, diapers, just things that they absolutely need, and including pharmaceuticals. And as we found out from Target, they're also continuing to spend money on makeup and beauty products as well. But they're not spending money on things like home improvements or clothing or electronics or things that they don't really need to do right now. And that begs the question, well, how did Target do? Because Target's grocery business isn't nearly as strong as Walmart's grocery business is. Well, Target also topped earnings expectations, but not really because of great sales. Their sales weren't actually all that great. The biggest reason why Target beat earnings expectations was really due to some one-off accounting rules that they were able to kind of implement. But the reality is sales were just kind of blah. Still, we did see the same thing from Target that we saw from Walmart. As customers buy fewer discretionary items, Target is drawing them into stores with groceries and everyday essentials. Unfortunately, Target's grocery is not nearly as strong as Walmart's, and Target's net income for the first quarter dropped, while their revenue rose slightly by about 1%. But there was something that Target said in their earnings that really concerns me, not only for Target, but really for all retailers. And it's the fact that consumer spending is really slowing down. And it's very possible that Q1 was the last quarter where we see really strong spending from consumers. Target said that shoppers spent less as the quarter went on. Sales were strong in February, but then weakened in March and softened even further towards the end of April. That means consumer spending in Q2 and Q3 could be really weak if this trend continues. And that could ultimately what puts us into the recession that so many chief financial officers, economists, and even the Federal Reserve is currently predicting. Now, we've got to talk about something else that's really hurting retailers and, as a result, keeping stocks from retailers down. And that is a major crime wave. Target said they expect organized retail crime-fueled losses to jump by $500 million this year. Target and other retailers are grappling with rising theft on top of slower sales and price-sensitive shoppers. Target said the problem affects all of us retailers. Home Depot, Walmart, Best Buy, Walgreens, and CVS have all spoken about the problem of theft. And it's not just people shoplifting. The retailers are actually focused on organized crime. The National Retail Federation spoke to CNBC on Thursday and said this is a very sophisticated local, state, national, and international organizations that are organized not just to steal at the store level, but throughout the entire supply chain, on the docks, on trucks, off ships, through containers, on the railways. It's really a problem across the supply chain. And that matches data recently provided to CNBC by insurance company Travelers. Travelers recently told CNBC that it has tracked a 600% increase in the form of cargo crime just in the last year. Most notably, no retailers surveyed by the National Retail Federation said organized retail crime has decreased. And while politicians and others want to focus on consumers not being able to afford necessities due to high inflation as being the reason for this spike in retail crime, it really appears from the data that this is really more of an organized crime due to a lack of punishment, a lack of investigations. Essentially, they're able to get away with it, and without enforcement, it's essentially legal in the sense of if a crime's not being enforced, then they're just going to keep on doing it because there's no reason not to. And this is the major problem. And of course, the lack of enforcement is not only on the local level in cities like San Francisco and others where essentially people are allowed to steal as much as they want so long as they don't go over a certain threshold. It's also more of on a national level where there's just not good way for a multi-police agency to really track these crimes and punish people. Unfortunately, we just don't have enough manpower to investigate all of these crimes, and that's the real reason why the crimes are increasing. Unfortunately, this causes a major hit to the bottom lines for companies. It keeps earnings down, and this unfortunately means the stock prices from retail companies continues to suffer as well, because if earnings are lower due to crime, stock prices are lower as well. So unfortunately, there's just not a good solution to this right now. But keep in mind that as crime increases, this pushes stock prices from retailers downwards. Now, the next thing that we need to get into is what's going on with the interest rate hike and inflation going into the June Fed meeting, which is coming up here in a few weeks. Dallas Fed President Logan said the current data does not justify pausing rate hikes yet. And she is actually the second Fed president this week to say that the Fed should not pause and should actually continue to raise rates. Keep in mind that coming out of the May meeting, there was a 97% chance that the Fed would pause at their meeting in June. But today, CME futures are painting a very different picture. Just last week, the chance of a Fed pause had dropped to 89%. Yesterday, it was at 72%. And today, the chance of a Fed pause in June is all the way down to 63%. That means the odds of the Fed raising interest rates again at their June meeting went from a 11% chance a week ago to a 28% chance yesterday to a 37% chance today. So it's now looking more and more likely like the Fed is going to raise rates again at their June meeting. And while the futures markets and the bond markets are starting to price this in, we've already seen Treasury yields start to rise as people, bond traders especially, start to expect the Fed to raise interest rates again in June. The stock market has not yet priced in more interest rate hikes. And the most notably, the stock market, not only are they still pricing in the Fed pause in June, but they're also pricing in 2 rate cuts this year. And right now, it's looking more and more likely like the Federal Reserve is going to raise rates in June and not do any rate cuts this year whatsoever. And most scarily is the fact, I don't know if scarily is a word. Anyway, the most concerning thing is the fact that the Federal Reserve has said they will continue to raise rates and keep rates elevated even if we go into a recession. So not only might the Fed cause a recession, they're going to keep rates elevated in a recession. And the stock market is in no way whatsoever pricing this in. So at some point, the stock market is going to have to price in the Fed continuing to raise rates and not cutting rates. And that means the stock market at some point is going to have to fall. Now, that's kind of what makes this $420 level on the S&P or at least the SPY, S&P 500 ETF, so important, is because the last time we hit this level, the stock market topped out and over the next 2 months hit new 52-week lows. Now, I don't think at all that the stock market is going to fall to new 52-week lows over the next 2 months. I'm just telling you that this level is a very, very strong level of resistance technically, and breaking above it, getting above it, and continuing this rally that we've been on is going to be very, very difficult from a technical standpoint. It's very possible. It's just very difficult. So while the market is absolutely risk on and bullish right now, we are hitting some technical resistance. We also have to look at stocks like Apple and Nvidia and others that are trading at some of the highest PE ratios in the company's history. I think Apple, Amazon, and Nvidia are all near the highest multiples they've ever been at. And that usually doesn't bode well for very long. Usually the stock market tops out of that point and starts to go down. So even though the market is absolutely risk on, absolutely bullish, and absolutely trending upward, just be aware of some technical issues as well as some fundamental issues that might pause this stock market rally here and push us down, at least temporarily. In no way do I think we're hitting new 52-week lows yet. I mean, we might if we enter a recession, but not yet. But technically, we may not continue higher, even though the trend is higher. So still kind of hard to say. Now, if we break the 420 level on SPY, absolutely, at that point, we've broken through that technical resistance barrier and we will just continue higher. But there's also equally as strong of a chance that we top out here and that we have a little bit of a pullback before we get our next leg up. So just be aware of what's going on. It still remains a very difficult environment to trade in. Unfortunately, earnings have not been rising enough to keep up with the rise in stock prices. Multiples are getting out of hand again. And historically, the stock market falls at this point. But given the extremely bullish market sentiment right now, the very risk-on environment, and the trend upward, it's hard to say if we'll actually get that pullback that we normally do or if we'll just continue higher. So just be careful. If you want to know what we are doing, I'm really focusing more on day trading lately, given the very uncertain swing trading environment right now. If you want to learn day trading, if you want to learn how to make money day trading, we have some very successful day trading coaches in my VIP coaching program. Somebody who makes over $100,000 a year day trading is in there to teach you how to day trade and how to make money with options. If you want to learn that so you can make money in this very uncertain environment, come join us in our coaching program. If you want more information on that, you can schedule a call with my onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you missed the last video I uploaded, make sure you watch the last video here.